All right, it's Money Monday, and because we are getting closer and closer to the end of the year, it's a good time to start thinking about rebalancing that portfolio. We're joining us now to talk about just that is Managing Director of DLG Wealth Management, Andy Guzzetti. Thank you so much for being with us this morning.
Always great to be here, Stephanie.
And I know that we're not even technically in November yet. Come tomorrow, we will be. We're already dealing with 2 snowstorms here in the capital region, but it is time to start thinking about 2012 and kind of where your investments lie, and over the course of the year, things change.
Right. Most people now will start in December, will start getting their end of the year statements, whether it's a brokerage account or an important 401k program. One of the things we do is we talk about rebalancing portfolios, having an asset allocation, and then rebalancing your portfolio either yearly, quarterly, or every 6 months. Let me give you an example, if I may. This is a hypothetical portfolio. It's based large cap growth fund, small cap growth fund, international, and a bond. Hypothetically, at January 1st, 25% in each one. On the December 31st statement, you can see now what the percentages are. So if you look at it, you're saying, well, look at the small cap growth fund. That's now 26.9% of this portfolio. The bond portion is 27.5. They must have been doing quite well. Most people would say, hey, let me get out of these lousy international fund, this long-term growth fund. Let me put it all in the small cap and a bond fund. And that's really what you shouldn't do, because over time, not every year does the same category outperform others. So what we tell people to do is rebalance your portfolio and sell the winners, get them into the losers, because over time this will lessen your risk and give you an opportunity to increase your return. So at the end of the year or the beginning of the year, rebalance your portfolio. This portfolio is done with risk tolerance, for your risk tolerance, your age. So if it's a correct asset allocation, you want to get it to there, and it'll lessen the risk of your portfolio.
Now, I think a lot of people, when they look at these numbers and they see kind of the change that happened from January 1 to December 31st, and they're seeing growth in certain categories, kind of the logical thing to do is to continue investing in those categories that are kind of giving you a return. But you're saying that over time, things kind of balance themselves out. So if you're just sticking with the winners in the past year, you might not actually be bettering yourself for the coming year.
Right. What we're saying is don't chase the hot dot.
Don't chase the hot dot.
I mean, that really could hurt you, because over time, if you're overinvested in one category, if that category does take a hit, then you take a major hit in your portfolio. Don't chase the hot dot.
So you need to be very well balanced. And that, you know, we've talked about risk, Andy, in the past, and making sure that all of your assets are spread out kind of evenly, so that if something happens to one market, you're not in the tank and you're not kind of hitting yourself.
Absolutely. Asset allocation, diversification is the key to lessen risk, and it will increase your returns over time.
So you're saying now is the time to do it. I know we're not even into November yet, but now is the time to start thinking about 2012.
Start thinking about it, because people start talking about the great funds of the year, and you're going to want to, again, chase the hot dot. Don't do it. Asset allocation into your risk tolerance, and you'll get a better return, less risk.
All right, Andy, thank you so much for being with us this morning.